Hey everybody, how you doing? Welcome to Market Minds. You are here with Mike Shore. I'm filling in today for my good friend and our CEO, Scott Bauer. How's everybody doing? Let me know that you can see, you should see calculate expected move. Should be able to hear me. Just want to make sure that you can do all that stuff. Sounds like everything, if people can hear. Just give me a yes if we can hear. Just so I'm not speaking perfect. Thank you, Mark. All right, so like I said, I'm filling in just for today, and we were going to talk about calculating the expected move, and then we can do rapid fire at the end, depending on how long this takes. So, expected move. What is it? Well, it's using the option markets and the implied volatility to predict what a probable move is, right? We trade in the realm of probabilities, not possibilities. Any stock that we're looking at, it can go to zero or it can go to 10,000, but we know that probably neither of those are going to happen. And so how do we statistically get the odds in our favor? And at the same time, if we're putting together a spread or something like that, putting together something that has the reward to risk that we require to put on a trade. All right, so why use the expected move? Well, that's how much the market is expecting, and it's not just somebody saying it, and that's why we like using it so much, because it actually uses market participation pricing to give you that move. Not just somebody saying, well, I think it's going to go to 120. There's an actual, because of the price of the options, there's actual people with money and skin in the game on both sides that are saying, this is too cheap, this is too expensive. And that's what the markets are all for. So I like doing it that way. All right. So when we're using the expected range, and we'll talk about how to calculate that, we're going to dramatically increase the probability that our trade will be profitable. And with a 68 statistical probability, that stock trades within this range. And this is how you can get that edge that traders talk about and stack the odds in your favor of winning. Okay, so this just happens to be in PPG. Okay, and one of the things that option pricing takes as a given is that we're going to look at a normal distribution. Okay, so for example, in this PPG Industries, if the expected move is $5, we'll go through that, but that means the expected move, and I don't have the implied volatility here. I'll go through an actual. I will go through an actual example, and but for example, let's just say that a stock for the year, this would be pretty darn small, but let's just say that it had a 5% implied volatility, and then the stock was trading 100. Well, that would mean 68% of the time, which is one standard deviation. It's not exactly 68. The calculus is a little bit, actually, well, we don't have to know exactly what it is, but 68% is a good round number for you to use. And that means that we are going to be either above this level of the expected move. Let's just say the expected move is $5, and we're going to be below this move, which is $5. Statistically, 68% of the time. Two standard deviations would be approximately 95% of the time. So if the expected move on a one standard deviation is $5, then it would be $10 on either side. That should happen statistically 95% of the time. And then if you went out to three standard deviations, well, that would be an expected move of $15 on each side. And that is about 99% of the time. That's why, certainly, everybody would like to be right with 100% of the time, but you're not going to be. And so that's when we deal with the probability of profitability. And it gives us, and most importantly, maybe most importantly, other traders are looking at standard deviations as well. So, it's statistically relevant, and it's also a self-fulfilling prophecy, because almost all of this stuff has some sort of standard deviation calculations to it. All right. But not do that one yet. Let me just pull in just a white sheet of paper here. And let's say anybody looking at anything, maybe for earnings, just throw out a name. It doesn't really matter. And we can calculate what that is. That Philip Morris or Move? I'm sorry, Move? Is that the stock? Let me pull this off here for a second. So Move, they don't have earnings coming up until April, so probably not a great one to look at. How about something that has earnings coming up? Airbnb? They were kind of soon. I was looking at them. Perfect. So they are on Thursday. Okay, so one quick back of the envelope type of calculation. You guys, I didn't see that the name of the day was already up. Back of the envelope calculation would be to look at the at the money straddle. So Airbnb is trading close to 140. And so we can say, well, the at the money straddle, we're going to buy a call and a put. It's not quite at the money. Trading for about somewhere around $12. Sorry, I didn't see that the word of the day was word. So we're looking at our Airbnb. Okay, earnings. Those are on 2/13, Thursday. And we know that I'll just say approximately at the money straddle is, I'm just going to call it $12. That's a quick back of the envelope type of calculation. Does it matter if it's 1180 or 1220? Probably not. But sometimes we're not all that close to being at the money, and there's a more rigorous way to calculate it, and I've actually put together a spreadsheet for that. And by using, move this over here. So in order to calculate the expected move, we need 3 pieces of information. Okay. 1, anybody know what they are? If not, that's why we're here. We're going to need 3 pieces of information. 1 is the stock price. 2, time to expiration. And 3, the implied volatility for that expiration above. All right. Price, IV. Okay, so given those 3 pieces of information, so we can look at something like Airbnb, and it's trading 139.68 right now. We know that we're going to be going out to the 14th because we're playing this for earnings, right? We're trying to model. Now we don't have an expiration. Well, it's coming out after the close on Thursday, so it's going to be a 1-day option that you're going to have. So we're going to go to 214, and the implied volatility for the 14th here, 143.1. So actually, the way that the Black-Scholes model works, that your at the money straddle is going to be closer to a 50% confidence interval. If you don't know what a confidence interval is, if you think about a full standard deviation being approximately a 68% confidence interval, then a 50% confidence interval would be a tighter estimate of what the expectation of the move means. Everybody with me on that? So you can see when we did this is about $12. So it's not quite perfect because we're not quite at the money, but 50% confidence interval is about 11.10. Full standard deviation move is $14.80. So depending on how aggressive or more conservative you want to be, usually you're looking, usually at least what I'm doing is I'm looking somewhere in between the 50% confidence interval and a full standard deviation move for earnings. So it gives us a range of what at least the market is pricing in right now. Full standard deviation move, a low of about 125, a high of about 155. If we go to a 50% confidence interval, that's a tighter interval, only about 8% as opposed to 10.5%. So that puts us at like 128.5 to the downside, 150 3/4 to the upside. Neither is right or wrong, but depending on the type of spread that you want to make sure that you're not, like if you're doing a calendar, you want to make sure that you don't blow through your strikes or something like that. You might want to target a full standard deviation move. If you think that maybe things are a little bit too overpriced, maybe you look at this. There's, like I said, there's nothing right or wrong. It's a matter of style and it's a matter of risk to reward. So now we have a decent idea of what the market is pricing in and what they're looking at. And like I said, whether it's statistically robust or a self-fulfilling prophecy, it almost doesn't matter. But these types of levels are respected. Now, that doesn't mean that we can't get a move that's more than a standard deviation or maybe even more than 2 standard deviation moves, but it doesn't happen all that often. So you have to weigh probability versus profitability. Okay, does everybody understand that? Or does anybody have any questions on that? The spreadsheet is available if you are a member of the STO room. But yes, all the tools that I use are available to all my STO students. There's nothing that I have off to the side that I just keep secret. You have the full playbook. Does anybody want to do another example or are there any questions? If not, we can go to rapid fire. And if I missed your question, I'm sorry about that. All right, Robert. Robert wants to do another one. What would you like to look at? PANW. All right, so first, PANW, they have earnings coming up on the 13th as well. So we know that we need price. So we need the price. That's going to be 195.67. We know that we're looking at the same day because earnings come out after the close. And the implied volatility here happens to be a little bit less than Airbnb. So they are looking at a full standard deviation move of 10.3%. Another important thing to keep in mind, does implied volatility tell us anything about direction? I can try and make this bigger. That's as big as I can make it. Exactly, Frank. Implied volatility does not tell us anything about direction. So hang on, let me get my drawing tool up here. Remember, we are, and excuse my, oh, this is actually pretty good. Remember, we are, one of our assumptions is that we have a normal distribution, with this being at the money. So it just tells us about the magnitude of the move. It doesn't tell us anything about direction. Now, it is true higher implied volatilities typically happen either before major events like maybe an FOMC decision, maybe unemployment, PCE, earnings. But it doesn't say, well, high implied volatility is bearish. High implied volatility could be bullish. But in general, implied volatility in stocks in general does go up as the market comes down, and then vice versa to the upside. We go up slowly, so implied volatility isn't all that scary. We tend to go down quickly, and that's why there's a little bit of a freak out component to the downside. Does that make sense? All right, any other questions on that? If not, we do have our word of the day already, which is word, and probably get this out of the way. And then let me bring up a daily chart here, just so you can, and this you should be able to see. All right, well, everybody have a chance to put in move. There you go. Word of the day is move. Best of luck to everybody on the spin of the wheel today. All right, well, how about some rapid fire? Did I miss anybody's question? I saw PANW we talked about. Or any stock that you want to talk about. Doesn't have to be earnings related. And exactly, Hulk, smash that like button, please. That helps us out a lot. Yeah, any names that you want me to break down? Earnings are a little bit tougher because technicals don't mean as much going into earnings. They do have a component to them. Okay, thank you. Bro? Brown and Brown? Is that what you mean, bro? Ty? I'm not familiar with the stock, but we're already past earnings. They've already paid their dividend. So what you're seeing here is you're seeing a bullish name, but what sticks out to you? I mean, really what should stick out to you is this little fun guy here. We had this swing high that we're sitting here right now. A settle above these highs, it's going to be bullish, but it's coming right up to resistance here. So this is kind of a make or break here. Either it's going to break out and then your next level is going to be this 114 level up here. If it comes back down, probably just kind of sits in the middle of this range, and then you got support here at, was that 105.16, somewhere around there? Somewhere around there. So if you want to be aggressive, taking out these highs right here, which it's kind of doing right now, is bullish. The more conservative way would be, well, let's wait and see if this actually holds during the day, and then we can look for a breakout tomorrow. All right, let me get rid of that, and then we can get back into here. Paid in, what is that? PDYN. Paladine. Okay. Well, a less expensive stock, only about a $10 stock. And you're just kind of range bound right here. Clearly taking out these 15 highs would be bullish. Of course, this stock going back to November was trading for $2. I don't know anything about Paladine. Your support is going to be here at the 50, which is at about $7.55. But I really don't, an aggressive takeout would be up here at 12 and a half. You're running into resistance, $2.50 higher than that. And then, like I said, it looks like it's just kind of pulling back and kind of holding. All right, ARM is the next one on my list. All right, so ARM, we had earnings. They were pretty well received, and now we're seeing this pullback. And if you notice, we did have these swing highs that held for a long time here at 156.40 or something like that. We're trading right there. If we can't get back above this nice congestion area, most likely you're going to be visiting this 50-day moving average. And, a turnaround, it's a little bit tougher because it's we've already filled this little gap here. I would probably look for it on an hourly chart and see where that breakout is. But it looks like at least for right now, it just kind of looks like it's stuck. Because we had that big move up. Yeah, it's just in the middle here. Take a look at A-Lab. Man, we got a lot of ones that are just kind of stuck. All right, A-Lab, they had earnings, not really well received. You do have support at this swing low at 79.43 with support at the 200 below it. And then really, I think that you got to wait until you take out you got to wait till we take out these highs, and then you got this baby gap from this high to this high. So if you do take that out, you're going to meet resistance here at the 50. So that's, basically 111.25. Still a decent move. 119-ish. Just trying to fill that little gap that they didn't get to fill yet from when this thing took a dive back in late January. So yeah, I mean, this support is important. It's probably worth a shot. We haven't been this low since what? 2 Novembers ago. Or excuse me, just 1 November ago. That's the last time we've been down here. So that and the 200 should be your support. And like I said, asking much more than the 50 is probably not great. Microsoft, next one up here. Microsoft's been a tough one to figure out. Really hasn't, for being one of the big players, one of the Magnificent Seven, it really has struggled. And earnings were no help. So now we're looking at something where they were pushing these lows going back to early November. They pushed through it and bounced, so that's good. I don't know if that's necessarily bullish. It's not as bearish just because you do have this support that did reject. Yeah, that's a tough one. You gotta maybe if you get up here, you're looking at the 200, but it's struggling. This would be more of a non-player for me. All right, Apple. Apple showed a little bit of strength this week, a little bit. But nowhere, again, you're running into resistance here at the 50, which is up at 240. We still have not tested this 200 day, which is probably pretty good. So again, range bound between the 50 and the 200. You could play that with an iron condor, but implied volatility is not going to be very high right now. I would have to wait until we got above the 50 for kind of any of these things to take a shot to the upside. Just does seem a little bit capped here. SPY. We can look at SPY. Well, SPY held its 50 even with the bad number that we had out today. Wasn't a horrible number, but it definitely was not what the market's looking for. We have rallied back. I mean, I think we were down well over 1% at one point, and we are now just down about 30 bips on the day. So it was important that we saw that we came off of here, we got below the 50 and we held it and we rallied. Here, we got below the 50 and barely got above it and settled above it, and now it's been holding the 50. So this is one that I think is a little bit more bullish, but you're still coming up. You got highs here up at 610 that, if you get in here, you're looking at what, $4 or $5 range and something that's a $600 stock, ETF in this case. So really the breakout is above this 610.78. But the fact that we are holding, and given that we had some non-friendly numbers, that's probably more bullish than bearish. All right, I think we have time for one more. Hang on a second. Let's take a look at Cisco, and then we'll spin that wheel. Yes. Oh. Earning. Why is it not doing that? Sorry. Okay, so earnings came off here a little bit, and now it's come back. So earnings came out, and they weren't exactly positive, but we were towards the top of the Dacian channel. So you see that we have a bunch of information in here. And sorry, I'm drawing something that I shouldn't be. That's what was messing me up. So breakout above 63.25, that's bullish. But I would have to wait to get through this mess here and let them figure it out. And then clearly the 50 has been support. So, just going back to December, support, 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 support. Now we're nowhere near that right now, but that 50 should be support on a pullback. So support here on the pullback, breakout above 63.25 for Cisco. All right, let me get that. Let me get that name of the wheel of names. Wow, I'm very appreciative, everybody. All right, everybody ready for the, here we go. All right. Well, we got a bill. So there are a couple bills here. The one that just went in, just Bill. Congratulations. If you and Barry, you're right. I got my days mixed up. You're right on Cisco. Mr. Bill. So Bill, if you're here, you can just say, all right. So just email your shirt size and address, prosperswag@prospertrading.com. Congratulations. All right, everybody. I want to say how much I appreciate you guys stopping by. We'll be back our normal schedule tomorrow. I hope everybody has a great rest of your trading day, and let's get back to it. Thanks a lot for coming by, everybody. Thank you so much.